Before we dive in, a quick but important note. I am not a licensed financial advisor or insurance agent. This presentation is for educational and informational purposes only. The information provided is based on extensive research and experience, but it should not be considered legal or financial advice. You should always consult with a qualified and licensed professional before making any decisions about your insurance coverage. Your individual situation is unique, and the right choices for you depend on your specific circumstances. You're driving home on the 5, traffic is finally starting to clear up, and then bam, someone rear-ends you. It's not terrible, just a crumpled bumper and a nasty jolt. You pull over, the other driver is apologetic, you exchange information. You think, okay, this is annoying, but that's what I pay insurance for. You call your provider the next day, give them the details, and a few days later you get the call that makes your stomach drop. The other driver? They had a policy but it lapsed 2 weeks ago. They're uninsured. Or maybe they have the absolute bare minimum coverage required by the state, which is so low it won't even cover half the cost to repair your newish car. Suddenly, you're the one on the hook. You're the one facing a $5,000 bill, a massive deductible, or a fight to get your own insurance company to cover it without jacking up your rates for years to come. This exact scenario, in 1,000 different variations, is the hidden nightmare of driving in California. And it happens because the entire auto insurance industry is built on a foundation of confusion. It's a maze of jargon, fine print, and policies that seem designed to take your money every month while providing as little as possible when you actually need it. They want you to be confused. They want you to just pick a policy, set it to autopay, and forget about it. Because an educated customer is their worst enemy. Well, today that ends. This isn't just another video explaining a few terms. This is a complete masterclass. Over the next 10 parts, we are going to pull back the curtain on the entire California auto insurance system. I am going to give you the exact knowledge, tools, and strategies you need to not only understand your policy inside and out, but to build a fortress of protection around yourself and your family, all while potentially cutting your current bill by hundreds or even thousands of dollars a year. By the end of this series, you will be able to look at any insurance quote and know precisely what you need, what you don't, and exactly where the insurance companies are trying to trick you. You will move from being a passive customer to an empowered consumer who is in complete control. So, let's start at the very beginning with the most fundamental question. What even is car insurance? Forget all the complicated terms for a second. At its core, insurance is just a simple transfer of risk. You have a car, which is a valuable asset. Driving that car creates risk. The risk of an accident, the risk of theft, the risk of a lawsuit that could wipe out your life savings. These are huge, potentially life-altering financial risks. Instead of shouldering that terrifying risk all by yourself, you pay a company a relatively small, predictable fee, your premium, and in exchange they agree to take on that giant, unpredictable risk for you. You are trading a small certainty for protection against a catastrophic uncertainty. That's it. That's the deal. When it works, it's a beautiful system. But the problem is, the details of that deal are buried in dozens of pages of legal documents you've probably never read. And in California, those details are more complex than anywhere else in the country. Why? Because California is a world unto itself. We have more drivers than any other state. Over 27 million registered vehicles. We have the most diverse driving conditions on the planet. You can go from a gridlocked commute in Los Angeles, to a snowy mountain pass in Tahoe, to a winding coastal highway in Big Sur, all in the same day. More cars, more people, and more varied risks mean a more complicated insurance market. Plus, California has a unique regulatory history that directly impacts your wallet. Back in 1988, voters passed something called Proposition 103. This was a landmark law that completely changed how insurance companies are allowed to set their prices. Unlike in many other states where insurers can use a wide range of factors to judge you, Prop 103 forced them to prioritize 3 things above all else: your driving record, the number of miles you drive each year, and your years of driving experience. This was meant to make things fairer, and in many ways it did. It prevents companies from basing your rate primarily on things like your zip code or your credit score. But it also created a unique system that you have to know how to navigate to get the best deal. So, how do we navigate it? We're going to break this entire universe down into 3 simple pillars. Think of these as the 3 core building blocks of your insurance knowledge. Pillar number 1 is the bare minimum. These are the coverages that the state of California legally requires you to have to even put your car on the road. We're talking about liability insurance, This is the coverage that pays for the damage you cause to other people and their property. We're going to dissect exactly what those state minimums are. And I'm going to show you why relying on them is one of the single biggest financial mistakes a Californian can make. It's like bringing a squirt gun to a forest fire. Pillar number 2 is your fortress. This is where we move beyond the legal minimums and talk about protecting you. This is the stuff that covers your car, your medical bills, and your financial future when things go wrong. We'll cover the critical differences between collision and comprehensive coverage. We'll demystify medical payments coverage or MedPay. And most importantly, we will do a deep dive into the single most important coverage you can buy in California: uninsured and underinsured motorist protection. This is the coverage that saves you when the person who hits you has little or no insurance. It is your absolute shield. And finally, pillar number 3 is the insider's playbook. This is where we get to the good stuff, saving money. I'm going to reveal all the discounts, strategies, and secrets the insurance companies don't exactly advertise on giant billboards. We'll talk about how to leverage your driving habits for a lower rate, the truth about telematics and tracking devices, how to bundle policies effectively, and when it's the right time to shop around for a new provider. You'll learn how to play the game by their rules and win. This series is your roadmap. We will go step by step through each of these pillars. No jargon will be left unexplained. No question will be left unanswered. You will leave this experience with a level of confidence and clarity you never thought possible when it comes to car insurance. You'll finally understand what you're paying for, why you're paying for it, and how to pay a whole lot less for even better protection. So let's begin with that first foundational pillar. What does the great state of California actually force you to have? What is the absolute bare minimum you need to be legal on the road? The numbers are going to shock you with how low they are, and understanding them is the first step to realizing just how exposed you might be right now. So let's rip the Band-Aid off. In the massive, modern, high-cost state of California, the minimum liability insurance you are legally required to carry is what's known as 15/30/5. I'll say it again: 15/30/5. It sounds like a secret code, but those 3 little numbers represent the absolute rock-bottom legal limit. They are the thin, frayed thread separating you from financial catastrophe. And understanding what they mean is the single most important thing you can learn about your car insurance. Let's break it down. The first number, 15, stands for $15,000. This is the maximum amount your insurance company will pay for bodily injury to a single person you injure in an accident that is your fault. One person, $15,000. The second number, 30, stands for $30,000. This is the maximum total amount your insurance will pay for bodily injuries for the entire accident if you injure 2 or more people. So, if you injure 3 people, that $30,000 is the entire pot of money that has to be split between all of them. It doesn't matter if their combined medical bills are $300,000. Your policy pays 30, and that's it. And the last number, the little 5, stands for $5,000. That's the maximum your insurance will pay for all property damage you cause in an accident. This mostly means the other person's car, but it could also mean you hit a mailbox, a light pole, or a storefront. $5,000 total. Now, pause for a second and really think about those numbers in the context of today's world. Does $15,000 sound like enough to cover a major injury? Does $5,000 sound like enough to fix a brand new car? The answer is a deafening no. These limits were set decades ago and have not kept pace with the soaring costs of medical care and vehicle repair. They are dangerously, almost laughably, low. And here's the scary part. Millions of drivers on California roads have only this exact level of coverage. To see why this is so terrifying, let's stop talking in hypotheticals and walk through a very common, very realistic scenario. Imagine you're driving home from work. You're a little tired, the sun is in your eyes, and for just a split second, you glance down at your phone to change the song. In that instant, traffic ahead of you stops. You look up too late and slam on your brakes, but you rear-end the car in front of you. It's a late-model Toyota Sienna minivan. A family car. It's a low-speed collision, maybe 15 miles per hour. Nobody seems seriously hurt, but the mom driving the minivan, let's call her Sarah, is shaken up and her neck is sore. Her husband is in the passenger seat, and their teenage son is in the back. You exchange information, a police report is filed, and you report the claim to your insurance company. You have the state minimum 15/30/5 policy. You think, okay, that's what insurance is for. A few days later, the calls begin. Sarah's sore neck turned out to be whiplash. The trip to the emergency room for an evaluation and x-rays was $2,000. The follow-up with an orthopedic specialist was $500. The specialist prescribed 6 weeks of physical therapy twice a week at $150 a session. That's another $1,800. She also missed a week of work as a dental hygienist, which is $2,000 in lost wages. Let's add that up. $2,000 for the ER, $500 for the specialist, $1,800 for physical therapy, and $2,000 in lost wages. We are already at $6,300. And that's for a simple, common whiplash injury, assuming there are no complications. But your policy limit for a single person is $15,000. So for Sarah, you're still covered. You breathe a small sigh of relief. But then you get the next call. The husband, Mark, also has back pain from the jolt. He too goes to the doctor, gets an MRI, and needs a few weeks of chiropractic care. His bills total $8,000. And their son in the back? He hit his head on the side window and has a mild concussion. His pediatrician visits a CT scan to be safe, and having to miss his part-time job for 2 weeks adds up to another $6,000. Now let's look at the second number on your policy, 30. The $30,000 maximum for all injuries in the accident. Sarah's bills are $6,300. Mark's bills are $8,000. Their son's bills are $6,000. The total medical cost for the family you just hit is $20,300. Phew, you're still under the $30,000 limit. Your insurance company will pay all of those bills. You got lucky. It was a close call, but your minimum policy did its job. Right? Wrong. Because we haven't even talked about the third number. The $5,000 limit for property damage. You get a call from the other driver's insurance adjuster. The body shop estimate for their Toyota Sienna is in. The rear bumper is cracked and needs to be replaced. But on a modern car, a bumper isn't just a piece of plastic. It's packed with technology. It contains backup sensors, blind spot monitoring radar, and cross-traffic alert systems. The bumper itself is $1,000. The sensors are another $1,500. The labor to paint the new bumper to match the rest of the car and install it is $1,200. And then all those sensitive electronics need to be recalibrated by the dealership, which is an $800 job. The total to repair their bumper is $4,500. Okay, you think my $5,000 limit covers that. But the impact also cracked one of their LED taillight assemblies. That's a $900 part. And the rear tailgate has a small dent that will cost $600 to repair. So the total damage to their vehicle is $6,000. Your policy, the one you pay for every month, the one that makes you a legal driver, will pay $5,000. And then it stops. The well is dry. Who pays the extra $1,000? You do. You are now personally on the hook for that money. The other person's insurance company will pay to fix their client's car. And then they will turn around and come after you for the difference. This is a process called subrogation. And they are relentless. They will send you letters, then they will send your file to a collection agency. Your credit score will be wrecked. If you don't pay, they can and will sue you in small claims court. But wait, the story gets so much worse. Let's go back to the injuries. What if Sarah's whiplash didn't get better? What if she developed chronic pain and headaches? Her doctors now say she needs injections, more therapy, maybe even surgery down the line. Her future medical costs are estimated at $50,000. And she's claiming she can no longer work as a dental hygienist, leading to a massive future lost wage claim. Now her total claim for bodily injury isn't $6,000. It's over $100,000. Remember your 15/30/5 policy? Your insurance company will write her a check for $15,000, the absolute maximum they are obligated to pay for her injuries. And that's it. They wash their hands of the situation. They have fulfilled their legal contract with you. You are now personally responsible for the rest. Suddenly, you receive a thick envelope from a law firm. You've been served. You are being personally sued for the remaining $85,000, plus pain and suffering, which their lawyer pegs at another $50,000. You are now facing a lawsuit for $135,000. This is the moment your life changes. They will go after your savings account. They will go after your paycheck through a wage garnishment. They can put a lien on your house, meaning you can't sell it or refinance it until they are paid. Everything you have worked for is now at risk, all because you were trying to save a few bucks a month on a policy that offered almost no real-world protection. That 15/30/5 policy isn't really insurance. It's a legal fiction. It's a piece of paper that allows you to get your registration sticker from the DMV. It protects you from a traffic ticket, but it does not protect you from life. This is the brutal reality of being underinsured. And this exact scenario plays out every single day on California's roads. People's financial lives are ruined not by some catastrophic multi-car pileup on the freeway, but by a simple momentary lapse of attention. So now you see the trap. But we've only looked at this from one side. We've talked about what happens when you cause the accident. What happens when the roles are reversed? What happens when someone with a 15/30/5 policy plows into the back of your brand new car? And you are the one with a serious injury. How do you protect yourself from them? Because their tiny policy isn't going to come close to covering your car, your medical bills, or your lost wages. There is a way. There are specific coverages you can add to your own policy that act as a shield against the millions of underinsured drivers out there. And understanding them is just as critical as understanding liability. This is where you go from defense to offense. Let's start with one of the most sobering statistics in California. It's estimated that 1 in every 7 drivers on the road with you right now has no insurance. 1 in 7. Think about that the next time you're stuck in traffic on the 5, the 101, or the 405. Look at the 7 cars around you. Statistically, one of them is a financial time bomb waiting to happen. And if they hit you, their lack of responsibility suddenly becomes your massive, life-altering problem. This is where you take control. This is where your insurance policy stops being just a legal requirement to protect others and starts being your personal financial bodyguard. We're talking about uninsured and underinsured motorist coverage, or UM/UIM. This is arguably the most important coverage you can buy for yourself, yet it's the one most people misunderstand or unwisely reject. Let's break it down. There are 2 main parts. First, uninsured motorist bodily injury, or UMBI. This coverage steps in when you are hit by a driver who has 0 insurance, and you or your passengers are injured. It also covers you in a hit and run, where the driver is unidentified and therefore, effectively uninsured. Second, there's underinsured motorist bodily injury, or UIMBI. This is for the scenario where the at-fault driver does have insurance, but they only carry the bare minimum state limits, that $15,000 we talked about. If your medical bills are $50, $70, or $100,000, their $15,000 is a drop in the bucket. UMBI is designed to fill that gap. In California, these 2 coverages are typically sold together as a package. You can't just buy one without the other. To really understand the power of this, let's imagine a scenario. Let's call our driver Maria. Maria is a responsible person. She works as a graphic designer. She has good insurance, and she's driving home from a client meeting in Irvine. She's stopped at a red light when suddenly, bam! She's violently rear-ended by a driver who was texting. The crash is severe. Her car is totaled, and she suffers a serious neck injury and a broken wrist. The other driver gets out, apologizes profusely, but then drops the bomb. "I'm so sorry, I don't have any insurance. I lost my job and let it lapse." Without uninsured motorist coverage, Maria's world just fell apart. Her health insurance will help with some of the initial medical bills, but she'll still be on the hook for thousands in deductibles and copays. The ambulance ride alone could be over $2,000. The ER visit, thousands more. Her neck injury requires ongoing physical therapy and might even need surgery down the line. Her broken wrist means she can't work for weeks, maybe months. As a graphic designer, her hands are her livelihood, so now she has no income. She can sue the other driver, right? Sure. She can spend thousands on a lawyer to get a judgment against a person who already admitted they couldn't afford a basic insurance policy. The court might order him to pay, but you can't get blood from a stone. He has no assets. So Maria is left with crippling medical debt, no car, no income, and a court judgment that's worth less than the paper it's printed on. This is a nightmare scenario that happens every single day in California. Now let's rewind. Let's give Maria uninsured motorist bodily injury coverage. She has a policy with UMBI limits of $100,000 per person and $300,000 per accident. Same crash, same uninsured driver. But this time, Maria's story has a different ending. She calls her own insurance company. She tells them what happened. They open an uninsured motorist claim. Her own policy now acts as if it were the insurance for the guy who hit her. It will pay for her ambulance ride, her ER visit, her surgery, her physical therapy. It will also pay for her lost wages while she's unable to work. And critically, it will also compensate her for pain and suffering, the non-economic damages that can be the most significant part of a serious injury claim. Her own insurance company makes her whole, up to her policy limit of $100,000. She's not bankrupted. She's not chasing a ghost for money. She's protected. Now let's change the scenario slightly to understand the underinsured part. Let's say the driver who hit Maria did have insurance, but it was a bare-bones state minimum policy, 15/30/5. Maria's medical bills and lost wages total $80,000. The at-fault driver's insurance company will pay out their policy limit, which is $15,000. That's all they are legally required to pay. So what about the other $65,000? This is where Maria's underinsured motorist coverage kicks in. Because her UMBI limit is $100,000, her policy will cover the difference. It pays the $65,000 gap between the other driver's pathetic limit and her actual damages. Again, she is made whole. She is protected from someone else's poor decision to carry inadequate insurance. So that covers your body, but what about your car? This is where the third piece of the puzzle comes in. Uninsured motorist property damage, or UMPD. This coverage pays to repair or replace your car if it's damaged by an identified uninsured driver. In California, this coverage is typically capped at $3,500. It's designed for people who don't have collision coverage on their policy. It's a small safety net. However, there's a big if here. You can only use UMPD if you can identify the driver who hit you. If it's a hit and run, UMPD will not apply. Also, you generally cannot have both UMPD and collision coverage. If you have collision, that's what you'll use to fix your car, and UMPD is unnecessary. You'll pay your collision deductible, and your insurance company will then try to get that money back from the uninsured driver. A process called subrogation. Good luck to them. The key takeaway is UMPD is a last resort for property damage if you don't have collision. Now for the most important question. How much UM/UIM coverage should you get? The answer is simple, and I want you to burn this into your memory. Your uninsured motorist limits should always, at a minimum, match your bodily injury liability limits. Think about the logic here. If you buy a 100/300 liability policy, you are telling the world, I believe I am capable of causing up to $100,000 in injuries to another person, and I want to be financially responsible for that. So, if you turn around and then select a 15/30th UM/UIM limit for yourself, you are essentially saying, even though I think I could cause $100,000 of harm to someone else, I think my own health, my own ability to earn an income, and my own well-being is only worth the state minimum of $15,000. It makes absolutely no sense. You are valuing a stranger's health more than your own. Protect yourself as much as you protect others. Look at your health insurance. What's your annual out-of-pocket maximum? Is it $5,000, $10,000, $15,000? A serious accident can blow past that in a single day. Think about your income. If you couldn't work for 6 months, how much money would you lose? That's what this coverage is for. It's not a luxury. It's a necessity in a state with millions of uninsured drivers. In California, insurance companies are required by law to offer you this coverage. To reject it, you have to physically sign a waiver. They will present you with a form, and you have to initial or sign next to a statement that says you are declining uninsured motorist protection. Do not do it. Saving a few dollars a month by signing that waiver is one of the riskiest financial gambles you can possibly make. You are betting your entire financial future that you'll never be the victim of an uninsured driver or a hit and run. That's a terrible bet to make on a California freeway. So we've covered your liability to others. And now we've covered your protection from the vast number of irresponsible drivers out there. You've built a fortress around your assets and your health. But what about the single biggest asset that's actually out there on the road? Your vehicle. Whether it's a 10-year-old commuter car or a brand new SUV, it's worth thousands of dollars. What happens when you hit a patch of black ice? Or a deer jumps out on a country road? Or a tree branch falls on your car during a storm? In those cases, there's no one else to blame. And that's when you need protection for your own property. That brings us to the dynamic duo of auto insurance, collision and comprehensive. Let's start with collision coverage. Think of it as your oops button. Collision pays to repair or replace your car if it's damaged in a collision with another object, or if it overturns. That other object is key. Most people think it just means another car, and it does, but it also covers hitting a telephone pole, a guardrail, a fence, or even a massive pothole that wrecks your axle. It covers damage to your car whether the accident was your fault or someone else's. Now you might be thinking, wait, if the other driver was at fault, shouldn't their liability insurance pay for my car? And you're absolutely right, they should. But what if they don't have insurance? Or what if they don't have enough insurance to cover your brand new SUV? Or what if it's a complicated he said, she said situation and the insurance companies are going to spend months arguing over who's at fault? In those scenarios, you can use your own collision coverage to get your car fixed right now. Your insurance company will then go after the at-fault driver's company to get their money back. A process called subrogation, but you're not stuck waiting. You're back on the road. The most common use for collision, though, is for single-car accidents where you are clearly at fault. Let's say you're backing out of a tight spot in a Trader Joe's parking lot. You're craning your neck, checking your mirrors, but you misjudged the distance and crunch. You've backed right into one of those concrete pillars. Your bumper is crumpled, a taillight is shattered. It's a $2,000 mistake. Your liability coverage won't do a thing for you here, because it only pays for damage you do to others. This is where collision coverage becomes your hero. Pays for the repairs to your car. But there's a catch, and it's a word you absolutely must understand. The deductible. A deductible is the amount of money you have to pay out of your own pocket for a claim before your insurance company starts paying. It's your share of the cost. Deductibles for collision coverage are typically $500 or $1,000. Let's go back to that parking lot pillar. The repair bill is $2,000, and you have a $500 collision deductible. You file a claim. You pay the first $500 to the auto body shop. Your insurance company then pays the remaining $1,500. If the damage was only, say, for $100, you wouldn't even file a claim because the cost of repair is less than your deductible. Here's the critical trade-off. The higher your deductible, the lower your monthly insurance premium will be. By choosing a $1,000 deductible instead of a $500 one, you're telling the insurance company, I'm willing to take on more financial risk myself in a small accident, so you should charge me less every month. It's a calculated gamble. You save money every month, but you need to be sure you have that higher deductible amount stashed away just in case you need it. Now, what about all the other bad things that can happen to your car that don't involve a collision? That's where the other half of our dynamic duo comes in. Comprehensive coverage. Comprehensive is sometimes called other than collision coverage, which is a perfect description. Protects your car from damage caused by, well, pretty much everything else. Think of it as the insurance for all the weird, random and unfortunate events life throws your way. The most common comprehensive claims are for theft. If your car is stolen and never recovered, comprehensive coverage will pay you its current value. It also covers vandalism. If someone keys your car or smashes your windows, it covers fire. It covers natural disasters like floods, hurricanes, and hailstorms that leave your car looking like a golf ball. One of the biggest ones, especially on California's beautiful rural highways, is hitting an animal. If a deer jumps out in front of you and you hit it, that's a comprehensive claim, not a collision claim. Why? Because you didn't collide with an object in the traditional sense. You collided with an act of nature. However, if you swerve to avoid the deer and hit a tree instead, that flips back to being a collision claim. It's a weird distinction, but an important one. Comprehensive also covers falling objects. A tree branch falls on your car during a windstorm? Comprehensive. A rock flies up from the truck in front of you and cracks your windshield? That's also a comprehensive claim, and in California, many insurance companies will actually waive your deductible for windshield repair, though not for a full replacement. Like collision, comprehensive coverage has a deductible that you choose and have to pay before the insurance kicks in. You can choose different deductible amounts for each coverage. You might have a $500 deductible for collision but only a $250 deductible for comprehensive, since those claims are often less severe. Together, collision and comprehensive are what people in the real world usually call full coverage. Now, I need to be very clear about this. Full coverage is not an official insurance term. You can't call your agent and buy a policy called full coverage. It's slang. It's just what people say when they mean a policy that includes the state-required liability, plus collision and comprehensive to protect their own vehicle. It's a convenient shorthand, but it can be misleading because no policy truly covers everything. There are always limits, exclusions, and of course deductibles. So, who needs these two coverages? Well, by law, nobody. California state law does not require you to have collision or comprehensive. But, and this is a huge but, if you have a loan on your car or if you're leasing it, your lender will absolutely 100% require you to have both. Why? Because until you make that final payment, the bank or finance company technically owns your car. It's their asset, their collateral for the loan they gave you. They need to protect their investment. If you get into a major accident and total the car without collision coverage, you would still owe the bank thousands of dollars for a car that no longer exists. The bank would lose its money. So they mandate that you carry both coverages with the deductible that's usually capped at $1,000 or less, and they require you to list them on the policy as the loss payee. This means if the car is totaled, the insurance check goes to them first to pay off your loan. Okay, so what if you're one of the lucky ones who owns your car outright? No loan, no lease. The title is in your name, free and clear. Do you still need collision and comprehensive? Now it becomes a personal financial decision. You have to weigh the cost of the coverage against the value of your car and your own ability to handle a financial hit. Here's the simple math you need to do. First, find out the actual cash value, or ACV, of your car. This isn't what you paid for it. It's what it's worth today with its age, mileage, and condition. You can get a good estimate from sites like Kelley Blue Book or Edmunds. Let's say your trusty 12-year-old sedan is worth about $3,000. Next, look at your insurance bill. How much are you paying per year specifically for collision and comprehensive? Let's say it's $600 a year, and your deductible is $1,000. Now think about the worst-case scenario: you total the car tomorrow. Your insurance company would write you a check for the car's value, which is $3,000, minus your $1,000 deductible. So, the maximum payout you could ever get from your insurance is $2,000. Is it worth paying $600 every year to protect yourself from a potential $2,000 loss? Maybe, but maybe not. If you have enough money in savings to absorb that loss, to either buy another $3,000 car or use it as a down payment on a new one, you might decide to drop the coverage and self-insure. You'd be saving that $600 a year in premiums. Over a few years, you'd have saved enough to cover the entire cost of the car. On the other hand, if your car is worth $30,000, paying $1,000 a year for collision and comprehensive is a no-brainer. The risk of losing a $30,000 asset is far too great for most people to bear on their own. Ultimately, collision and comprehensive coverage are about protecting your assets and managing your risk. They ensure that a single bad moment, a mistake in a parking lot, a deer on the road, or a thief in the night, doesn't turn into a devastating financial crisis. But what happens when the crisis isn't about your car, but about your health? Or when the other driver, the one who hit you, has no insurance at all? That's a whole different kind of risk, and it requires a whole different set of coverages to protect you. This is where the game changes, because we've been talking about protecting a thing, a piece of metal, glass, and plastic that you can, in the end, replace. But now we're talking about protecting a person. We're talking about protecting you and your passengers, your family. Imagine this. You're driving home on the 405, traffic is what it is, and suddenly bam. You're rear-ended. It's not a catastrophic crash, but it's a solid hit. The airbag deploys, your neck is jolted, your wrist is throbbing. The paramedics check you out, and an ambulance takes you to the emergency room just to be safe. Your car is towed away. Few days later, you get the call. Your collision coverage is kicking in, the adjuster has seen the car, and the check for repairs is on its way. You feel a wave of relief. The system works. But then a week later, the first envelope arrives. It's from the ambulance company. It's a bill for $2,000. The next day, another one comes. It's from the emergency room. It's for $5,000 for the visit, the x-rays, the doctor's time. Then comes the bill from the radiologist who read the x-rays. That's another $500. You start to realize the hit to your car was nothing compared to the hit your finances are about to take. You think, okay, I have health insurance. And you do. But then you remember your plan has a $3,000 deductible. And after that, you still have a 20% co-insurance payment on everything. So even with good health insurance, you're on the hook for thousands of dollars out of your own pocket right now. All because someone else wasn't paying attention. This is the exact scenario that medical payments coverage, or MedPay, was designed to solve. Think of MedPay as a small dedicated emergency fund for medical bills that's built right into your auto policy. It's the financial first aid kit. The key thing to understand about MedPay is that it is no-fault coverage. It doesn't matter who caused the accident. If you are injured in your car, or even as a pedestrian hit by a car, you can use your MedPay. It also covers any passengers who were in your car with you. It's designed to be fast and easy. There's no lengthy investigation to figure out who was at fault. You get in an accident, you incur a medical expense, you submit the bill to your auto insurance, and they pay it right up to the limit you selected. Those limits are usually smaller amounts like $1,000, $2,000, $5,000, or maybe $10,000. The goal isn't to cover a catastrophic, life-altering injury. The goal is to immediately handle those initial unexpected costs. The ambulance ride, the ER visit, the health insurance deductible, the copays, the follow-up visits to a physical therapist. It smooths over the immediate financial shock, so you don't have to drain your savings account or rack up credit card debt while you wait for the bigger insurance settlements to be figured out. It's relatively inexpensive to add, and for the peace of mind it provides, it's one of the best bargains in auto insurance. But what if the situation is worse? Let's go back to our story. The bills keep coming. It turns out that neck jolt was a serious whiplash injury. You need months of physical therapy. You've missed 2 weeks of work and your boss is starting to make noises. The total cost isn't just a few thousand anymore. It's quickly climbing to $50,000, $60,000, $70,000 in medical bills and lost wages. Your $5,000 MedPay limit was a huge help at the beginning, but it's long gone now. This, you think, is what the other driver's insurance is for. They were at fault. Their bodily injury liability coverage should pay for all of this. So your insurance company reaches out to theirs to start the claim. And that's when you get the worst possible news. The driver who hit you has no insurance. Or, almost as bad, they have the absolute bare minimum required by the state of California. As we discussed, that's just $15,000 for a single person's injuries. Your bills are already 4 times that amount, and you're not done with treatment. Suddenly, you're facing a financial catastrophe. You did everything right. You were a safe driver. You bought good insurance. But the carelessness of one other person, a person who broke the law by driving uninsured, or who was only willing to buy the cheapest policy possible, is threatening to ruin you financially. This isn't a rare 1 in a million scenario. The Insurance Research Council estimates that 1 in 8 drivers on the road is uninsured. In California, some estimates put that number even higher. That's a terrifying roll of the dice every single time you get on the freeway. This is why the single most important coverage you can buy to protect yourself and your family is uninsured and underinsured motorist coverage. Let's call it UM/UM. If liability coverage is about protecting your assets from others, UM/UIM is about protecting your health from others. It's you buying insurance for the other guy, just in case he didn't buy any for himself. It steps in and takes the place of the at-fault driver's non-existent or inadequate insurance policy. It's broken into 2 parts. First, there's uninsured motorist bodily injury, or UMBI. This is for when the at-fault driver has 0 insurance. If they hit you and you're injured, your own UMBI coverage pays for your medical bills, your lost income, and even for things like pain and suffering. It essentially allows you to sue your own insurance company as if they were the at-fault driver, giving you access to the compensation you rightfully deserve. Second, there's underinsured motorist bodily injury, or UIMBI. This is for that other, more common scenario where the at-fault driver has insurance, but their limits are way too low to cover your expenses. Let's say your total damages, medical bills, lost wages, everything, come to $100,000. The driver who hit you has the California state minimum of $15,000. Their insurance will pay out that $15,000. Then your UIMBI coverage will kick in to cover the rest, the remaining $85,000, up to the limit you chose on your own policy. This is absolutely critical. Without it, you get that first $15,000 and that's it. You'd be left with a mountain of bills and very few options. The limits for UM/UIM coverage typically mirror the bodily injury liability limits you choose for yourself. So if you choose 100/300 limits to protect your assets if you cause an accident, you would also get 100/300 limits to protect yourself if an uninsured or underinsured driver injures you. It's a simple rule of thumb. You should never have less coverage for yourself than you have for a stranger. Protect yourself as well as you protect others. There's also a less common property damage component, called Uninsured Motorist Property Damage, or UMPD. This coverage will pay to fix your car, up to a certain limit, if you're hit by a confirmed uninsured driver. It's an alternative to using your own collision coverage. The main benefit is that the deductible is much lower. However, it only applies in this one very specific situation. If you're in a hit and run, or if the other driver is just underinsured, or if you caused the accident yourself, UMPD does nothing. For that reason, most experts agree that having a good collision policy is the far superior and more comprehensive way to protect your vehicle. So let's put it all together. MedPay is your immediate, no-fault financial first aid kit for smaller medical bills. Uninsured and underinsured motorist coverage is your ironclad shield, your lawsuit in a box that protects you from financial ruin when your injuries are severe and the other person can't pay. These coverages aren't about your car. They are about your life, your health, your ability to earn an income. They form a personal safety net that sits inside your auto policy. We've now covered how to fix your car when it's damaged and how to pay for your medical bills when you're injured. We've built a fortress to protect you from the chaos of the road. But every fortress has two sides. We've talked about what happens when other people hit you. But what happens when the roles are reversed? What happens when that moment of distraction, that split-second mistake, is yours? That deafening silence after the crunch of metal and the shatter of glass. The world slows down. Your heart is pounding in your ears, a frantic drumbeat against the sudden, shocking stillness. You look at the other car, the steam rising from its crumpled hood, and a single terrifying thought crystallizes in your mind. This was my fault. In that moment, your insurance policy isn't just a piece of paper in your glove box. It transforms. It becomes the only thing standing between you and a tidal wave of financial ruin. This is the moment where liability coverage steps out of the shadows and becomes the most important promise you've ever paid for. Liability coverage is not for you. Not directly. It's for everyone else on the road. It's your financial armor against the consequences of your mistakes. It's the money that pays for the other person's wrecked car, their hospital bills, their lost wages, their pain and suffering. It's the coverage that the state of California legally requires you to have before you even turn the key. And it's broken down into two critical parts: bodily injury liability and property damage liability. Let's start with bodily injury, or BI. This is for the people. If you cause an accident and someone in the other car, or a pedestrian or a cyclist gets hurt, this is the part of your policy that pays their medical bills. It covers everything from the ambulance ride and the emergency room visit to surgery, physical therapy, and even long-term care if the injuries are severe. But it goes further. It also covers their lost wages if they can't work, and it pays for the intangible, but very real, cost of their pain and suffering. It's the coverage that addresses the human cost of an accident. Then there's property damage liability, or PD. This is for the things. It pays to repair or replace the other person's car you just hit. But it's not just their car. If you swerve and take out a homeowner's prize-winning rose bushes and a section of their white picket fence, your property damage coverage pays for that. If you skid on a wet road and smash into a storefront, it pays for the broken window and damaged inventory. Anything you break that belongs to someone else, this is the fund that pays to fix it. Now, here is the most important and frankly the most terrifying part of this entire guide. The state of California has minimum liability requirements. To be legally insured, you must carry, at a bare minimum, what's known as 15/30/5 coverage. Let's break down what those numbers actually mean, because they represent the thinnest possible layer of ice you could ever skate on. The first number, 15, stands for $15,000. That is the maximum amount your insurance will pay for the bodily injury of a single person you injure in an accident. One person, $15,000. The second number, 30, stands for $30,000. That is the maximum total amount your insurance will pay for the bodily injuries of everyone you injure in a single accident. If you hit a car with 3 people in it and they all get hurt, your policy will pay out a grand total of $30,000 to be split between them, with no one person getting more than $15,000. The last number, 5, stands for $5,000. That is the maximum amount your insurance will pay for all the property damage you cause in an accident. Let that sink in. 15, 30, 5. These numbers were set decades ago, and they have not kept up with the reality of our world. Carrying the state minimum insurance is, without exaggeration, one of the biggest financial gambles a person can take in California. It is a trap. Let's talk about that $5,000 for property damage first. $5,000. Look around you on the freeway. The average price of a new car in the United States is now over $48,000. You see that Tesla Model 3 in the next lane? A minor fender bender can easily result in a $10,000 repair bill because of the sensors and cameras in the bumper. That brand new Ford F-150? You could total it. That's a $60,000 truck. What happens when your $5,000 runs out? The other driver's insurance company will pay to fix their client's truck. And then their lawyers will turn around and come after you personally for the remaining $55,000. Not your insurance company, you. But the property damage is the small part. The truly life-altering risk is on the bodily injury side. $15,000. Have you ever seen a hospital bill? A single ambulance ride can cost over $2,000. An MRI? Another $1,000 or $2,000. One night in a hospital can be $5,000 or more, without any major procedures. What if the person you hit breaks their leg and needs surgery? A plate, some screws, a surgeon, an anesthesiologist, a hospital stay. That $15,000 is gone before they're even discharged. And we haven't even talked about the months of physical therapy they'll need afterwards. Now imagine a worse scenario. What if you cause a multi-car pileup? You have $30,000 total to cover the injuries of everyone involved. One person's broken arm could exhaust that entire limit, leaving the other injured parties with nothing from your insurance. And who do you think they will come after for their medical bills? Who will they sue for their lost income and their suffering? They will sue you. This is not a scare tactic. This is the cold, hard reality of the legal and medical system. When your insurance limits are exhausted, the other party's attorneys will look at your life and see what they can take. They will go after your savings account. They will go after your investments. They can force the sale of your assets. They can put a lien on your home, meaning you can't sell it or refinance it without paying them first. And most devastatingly, they can get a court order to garnish your wages, taking a percentage of your paycheck every single week for years, or even decades until the debt is paid. A single mistake on the road, a moment of looking at your phone, of being too tired, of just bad luck, while carrying state minimum insurance can financially ruin you. It can wipe out a lifetime of hard work, destroy your plans for retirement, and steal your children's college fund. Everything you have built can be dismantled because of a policy that cost a few dollars less per month. So what should you do? The answer is simple. Protect your assets. The amount of liability insurance you carry should be directly related to how much you have to lose. A common recommendation for a starting point, a much safer baseline, is 100/300/100. Let's translate that. That's $100,000 for a single person's injuries, $300,000 total for all injuries in an accident, and $100,000 for property damage. This level of coverage can handle totaling most new cars and can absorb the costs of a serious, but not catastrophic, injury. It moves you from the danger zone into a place of reasonable security. If you are a homeowner, if you have significant savings or a retirement account, you should consider even higher limits like $250/500/100. The goal is to have enough coverage so that if the worst happens, the insurance company writes the check, not you. And here's the secret the insurance companies don't always advertise. The cost to increase your liability limits is shockingly small. Going from the disastrous 15/30/5 to a much safer 50/100/50 might only cost you an extra $15 or $20 a month. Jumping from there to 100/300/100 might be another $10 or $15 on top of that. We're talking about the price of a couple of cups of coffee or a Netflix subscription. It is, without a doubt, the single best value in all of insurance, buying hundreds of thousands of dollars of financial protection for pennies on the dollar. It's buying peace of mind. It's buying the ability to sleep at night. Your liability coverage is your shield. It protects your future from your past mistakes. You've now built the fortress walls to protect your financial life from the claims of others. But what about you? What about your own passengers? What happens to your own medical bills if you're the one at fault? Or if you're hit by someone with no insurance at all? Your liability shield doesn't cover you. For that, you need to build the tower inside the walls. And that's the next critical piece of this puzzle. This internal tower has two main pillars. The first is your on-call medic, the first responder for anyone inside your car. It's called medical payments coverage, or MedPay, and it is beautifully simple. If you are in an accident, regardless of who is at fault, MedPay helps pay the medical bills for you and your passengers, up to a certain limit. You could have run a red light, T-boned someone, and it was 100% your fault. MedPay doesn't care. It doesn't ask questions about blame. It just shows up with the stack of cash and says, "Where does it hurt? Let's get that ambulance bill paid. Let's cover that emergency room copay. Let's take care of that dental work needed because you hit the steering wheel." Think of it as a small, dedicated health insurance policy just for car accidents. The limits are usually modest. You'll see options like $1,000, $5,000, $10,000, maybe $25,000. And because the limits are relatively low, the cost to add it to your policy is often shockingly small. We're talking a few dollars a month. So why is this tiny, cheap coverage so important? Because of what happens in the first few hours and days after a crash. Your regular health insurance might have a $5,000 deductible. Guess who pays that deductible before your health plan kicks in a single dollar? You do. But if you have $5,000 in MedPay, it can pay that deductible for you. Problem solved. What if you have friends in the car? Your buddy in the passenger seat breaks his wrist. Are you going to ask him to submit the bills to his own insurance and hope for the best? That's an awkward, friendship-straining conversation. With MedPay, you can just say, "Don't worry, my auto insurance has it covered." It's immediate, no-fault goodwill in a can. Keeps the peace and gets people the care they need right away. And here's a secret power of MedPay that almost nobody knows about. In many cases, it follows you, not just your car. If you are walking across the street and get hit by a car as a pedestrian, or you're riding your bike and get clipped, your own MedPay coverage can often step in to pay your initial medical bills. It's a pocket-sized guardian angel. For the price of a couple of fancy coffees a month, you get a financial first aid kit that works instantly without blame or bureaucracy. It's the medic inside your castle walls, patching people up so you can deal with the bigger battle. But a medic can only do so much. A first aid kit is great for a broken wrist, but it's not going to help if you've suffered a life-altering injury. It won't replace your income for the 6 months you can't work. It won't compensate you for the permanent limp you now have. And it's completely useless against the single biggest threat on California roads. It's not drunk drivers, it's not speeders, it's ghosts. The drivers who cause devastating harm and then simply vanish financially speaking. I'm talking about uninsured and underinsured motorists. This is the second and far more important pillar of your internal tower. Let's be brutally honest. California has a massive problem with uninsured drivers. The official estimates say around 1 in 7 drivers has no insurance. But ask any traffic cop or insurance adjuster, and they'll tell you the real number is likely much, much higher in certain areas. Could be 1 in 5, maybe even 1 in 4. That means every time you're on the freeway, you are surrounded by people who have zero ability to pay for the damage they cause. They are financial ghosts. If one of them slams into you, their liability insurance, that protective wall we talked about, doesn't exist. It's a mirage. You can sue them personally, sure, but you can't get blood from a stone. If they couldn't afford a basic insurance policy, they don't have a 6-figure savings account waiting for you. A lawsuit will get you a piece of paper, a court judgment that is utterly worthless. This is where uninsured motorist bodily injury, or UMBI coverage, saves you. It is, without exaggeration, one of the most important coverages you can possibly buy. When you are hit by a driver with no insurance, your own insurance company steps into the shoes of that ghost driver. You essentially make a claim against yourself. Your insurer pays for your medical bills, your lost wages, your pain and suffering, and your future medical needs, up to the limits you selected. You get the settlement you would have gotten from the at-fault driver, if they had been a responsible person with insurance. Your own policy becomes the shield you desperately need. This also covers you in a hit and run, when the driver is literally a ghost who disappears into the night. Without this coverage, you are completely on your own. Now let's talk about the other phantom, the underinsured motorist. This one is almost worse because it's more deceptive. This is the person who did the absolute bare minimum. They bought that 15/30th liability policy we talked about earlier. They are technically insured, but they are so profoundly underinsured that it's almost meaningless in a serious crash. Let's imagine you're sitting at a stoplight. A driver texting doesn't see the red light and plows into the back of your car at 50 miles per hour. Your car is totaled. You suffer a severe spinal injury that requires surgery, months of physical therapy, and leaves you unable to work your construction job for a year. Your medical bills alone are $150,000. Your lost income is another $60,000. Your life is permanently changed. You discover the driver who hit you has the state minimum 15/30 policy. That means their insurance will pay a maximum of $15,000 for your injuries. $15,000. That might not even cover the ambulance ride and the initial MRI. It's a drop in an ocean of debt. This is where underinsured motorist, or UIM coverage, kicks in. It bridges the gap. If you have UIM coverage of, say, $250/500, your policy would look at the situation and say, okay, the other guy's insurance paid $15,000. The total damages are over $200,000. Your UIM limit is $250,000. So we will step in and pay the remaining difference, up to your limit. It takes that pathetic, useless check from the other driver and adds the money needed to actually make you whole. So here is the single most important piece of advice in this entire series. Listen closely. You should always carry uninsured and underinsured motorist limits that are equal to your own bodily injury liability limits. Let me repeat that. Match your UM/UIM limits to your liability limits. If you have 100/300 in liability to protect your assets from a stranger, you need 100/300 in UM/UIM to protect your health and your family from a stranger. Think about the logic here. Why on earth would you buy more insurance to protect a random person you might hit than you would buy to protect yourself and your own children from that same random person? It makes zero sense. To say, I'll carry a $250,000 shield to protect a stranger from me, but I'll only carry a $15,000 shield to protect my own family from that stranger, is a catastrophic failure of priorities. And yet, millions of people do it every day to save a few bucks. It is the single biggest gamble you can take with your financial future and your physical well-being. Don't do it. Match your limits. MedPay is the medic who patches your wounds on the battlefield. UM/UIM is the elite cavalry that rides in to save you when you're facing an enemy with no army or an army of one. They work together. MedPay gives you immediate cash for the ER. UM/UIM handles the life-changing debt from surgery and lost wages. Together, they form the strong, secure tower inside your castle walls. They ensure that no matter what happens out there, no matter how irresponsible the other driver is, you and your family are protected. So you've built the walls and you've secured the tower inside. Your castle is protected from outside attacks and can care for its own. But what about the castle itself? What happens when a fiery dragon, or a runaway semi-truck, crashes into your beautiful chariot? Protecting your actual car is a whole different battle, and that's where we go next. This is where we separate the basic shield from the full suit of armor. Protecting your car itself is known as physical damage coverage, and it's split into two legendary protectors, two master blacksmiths who can hammer your chariot back into shape: collision and comprehensive. They sound similar, but they protect you from completely different dragons. Let's start with the one that's easier to understand: collision. Collision coverage is exactly what it sounds like. It pays to repair or replace your car if it's damaged in a collision with another object. Think of it this way: collision is for when your chariot is in motion and it hits something. You, the knight, are at the reins. Maybe you misjudge a turn and hit a guardrail. Maybe you back into a pole in a parking garage. Or maybe you're in a classic fender bender with another car. In all these cases, it's the impact, the collision, that causes the damage. This coverage is your go-to for fixing your own car after a crash. And here's a critical point that trips a lot of people up. Collision coverage pays out regardless of who is at fault. Let's say you rear-end someone. It's clearly your fault. Your liability coverage, which we talked about before, will pay for the damage to their car. But what about your car? Your front end is smashed in. Without collision coverage, you are paying for that repair entirely out of your own pocket. With collision coverage, your insurance company steps in to pay for your repairs. Now let's flip it. Someone else runs a red light and T-bones you. It's clearly their fault. Their liability insurance should pay for your car's repairs. But what if they don't have insurance? Or what if they don't have enough insurance to cover your brand new Tesla? Or what if their insurance company is slow, difficult, and wants to fight about the claim for months? This is where having your own collision coverage is like having a secret weapon. You can file the claim with your own insurance company. They will pay you quickly to get your car fixed, and then they will take on the headache of going after the other driver's insurance company to get that money back. That process is called subrogation, and it means you get your car fixed now, and let the billion-dollar insurance companies fight it out amongst themselves. You get back on the road, they handle the war. But there's always a catch, isn't there? In the world of insurance, that catch is called the deductible. The deductible is the amount of money you have to pay out of pocket for a repair before the insurance company starts paying. Think of it as your copay for a car accident. Deductibles for collision coverage are typically set at amounts like $500, $1,000, or even $2,500. Let's run the numbers. Say you have a $1,000 deductible. You get into an accident that causes $8,000 in damage to your car. You will pay the first $1,000 directly to the body shop. Your insurance company will then pay the remaining $7,000. If the damage was only $900, you'd pay the whole thing yourself because it's less than your deductible. You wouldn't even file a claim. This is where you have some control. Choosing a higher deductible, like $2,500, will lower your monthly insurance premium. Why? Because you're telling the insurance company you're willing to take on more financial risk yourself, so they reward you with a lower price. Choosing a lower deductible like $500 means your premium will be higher, but you'll have a smaller bill if you ever get in a crash. It's a trade-off. Save money now on your premium, or save money later if you have a claim. It's a personal financial decision, A bet on your own driving. So that's collision. It covers your car when it hits an object or gets overturned. But what about all the other chaos the world can throw at your car? What about the things that happen when you're not even driving it? This is where the second master blacksmith comes in. Comprehensive coverage. Some people call it other than collision coverage, which is actually a perfect description. This is the coverage for almost everything else. It's for the random, unpredictable events. It's for the acts of nature and the acts of criminals. Let's go back to our chariot analogy. Comprehensive is for when your chariot is just sitting in the stable, minding its own business, and a nasty storm causes a tree branch to fall and crush the roof. Or a thief sneaks in overnight and steals the whole chariot. Or vandals spray paint graffiti all over the side. Or a deer, a wild beast of the forest, leaps out of the woods and smashes into you while you're driving down a country road. Wait, hitting a deer? Isn't that a collision? This is one of the weirdest and most important distinctions in auto insurance. Hitting a live animal is almost always covered under your comprehensive policy, not your collision policy. The logic is that you couldn't have reasonably avoided a deer suddenly jumping into your path, so it's considered an unpredictable, non-driving error event, like a falling rock. However, if you swerve to avoid the deer and end up hitting a tree instead, that crash with the tree is now covered by your collision policy. Weird, right? But that's how it works. So to recap, comprehensive covers a huge list of potential disasters. Theft of your entire car, fire, vandalism and riots, natural disasters like floods, hail, windstorms, and earthquakes, falling objects like tree limbs or rocks in a landslide, and of course hitting an animal. Just like collision, comprehensive coverage also has a deductible, and you can often choose a different deductible amount for it. Many people choose a lower deductible for comprehensive because the claims are often for things like a cracked windshield, which are more common and less expensive than a major collision. Now for the multi-million-dollar question. Do you actually need collision and comprehensive coverage? The state of California does not legally require you to have them. The law only cares that you can pay for damage you do to others, that's liability. But just because it's not legally required doesn't mean you don't need it. There are two main scenarios. First, do you have a loan on your car? Or are you leasing it? If the answer is yes, then the answer is yes. You need both. In fact, your lender or leasing company will contractually require you to have them. Why? Because until you pay it off, they technically own that car. It's their asset, their collateral. They are not going to let you drive their multi-thousand-dollar asset around without full protection. If you wreck it, they want to be sure their investment is covered. If you try to remove this coverage, they can actually buy a policy for you, a very, very expensive one, and add the cost to your loan payment. So if you have a loan or lease, this isn't really a choice. The second scenario is if you own your car outright. You have the title free and clear. Now, it becomes a purely financial decision. You have to ask yourself a simple and sometimes scary question. If my car were totaled tomorrow, could I afford to go out and buy another one with cash without it causing a major financial crisis? If your car is a 15-year-old beater worth $2,000, and you have a $1,000 deductible, you're paying a premium every month to protect just $1,000 of value. It might make sense to drop collision and comprehensive and just self-insure, meaning you save that premium money in a separate account and accept the risk of replacing it yourself if something happens. But if you're driving a $30,000 car that you rely on to get to work every single day, and you don't have $30,000 sitting in the bank, then dropping this coverage would be a massive, potentially life-altering gamble. One bad driver, one hailstorm, one stolen car, and you could be left with no transportation and no money to replace it. For most people, collision and comprehensive coverage isn't a luxury. It's the essential protection that keeps their life running smoothly. It's the armor that ensures that even after a bad joust, your chariot can be rebuilt, and you can get back in the tournament. So we've armed our knight to protect others with liability, and we've armored our chariot itself with collision and comprehensive. But the protection doesn't stop there. What about when your trusty steed is in the blacksmith shop for a week? How do you get to work? What about all the expensive personal items you had inside the car when it was stolen? These are the crucial details, the gaps in the armor that can leave you stranded and frustrated, even when you thought you were fully covered. And plugging those gaps is what we're tackling next. Let's start with the most common and arguably one of the most frustrating gaps in coverage. What happens to you while your car is being fixed? We're talking about rental car reimbursement. Sounds minor, but I want you to picture this. You're in an accident. It wasn't your fault, but the other driver's insurance is dragging their feet. Your car is in the body shop and the mechanic says it's going to be 3, maybe 4 weeks. Your collision coverage is handling the repairs, so you're good there. But how do you get to work tomorrow? How do you take your kids to school? You call your insurance company, confident, and they say, "Sorry, you didn't select rental reimbursement coverage." Suddenly, you're looking at a bill for $1,000, maybe $1,500 just for a basic rental car, all coming straight out of your pocket. All because you tried to save, what, $5 or $6 a month? Rental reimbursement is that safety net. It typically offers a certain amount per day, say $30 or $50, for a maximum of 30 days. It's not a luxury, it's a lifeline that keeps your world turning when your car can't. Now let's talk about another moment of absolute frustration. Being stranded on the side of the road. It's 10 p.m. on a Tuesday, you're on a dark stretch of the 15 heading out of San Diego, and your tire blows. Or maybe your engine just stops. You're safe, but you're stuck. You call a tow truck, and the dispatcher quotes you $400 to tow you to the nearest open mechanic. $400 for a single tow. This is where roadside assistance coverage comes in. For pennies on the dollar, often less than the cost of one fancy coffee a month, this add-on covers towing, flat tire changes, jump starts, fuel delivery if you run out of gas, and even locksmith services if you lock your keys in the car. Most people think, "Oh, I have a separate auto club membership for that." And that's great. But check the price. Often, adding it to your auto insurance policy is significantly cheaper and more convenient, bundling everything under one bill and one number to call when things go wrong. Don't be the person paying a fortune for a tow truck at midnight. Alright, let's move from inconveniences to something that can cost you thousands in an instant. This one is for anyone who loves their car. You've spent money on it. You didn't just buy a car. You built a machine that's uniquely yours. We're talking about those 20-inch custom rims, that $1,000 sound system, the slick vinyl wrap, the performance exhaust. You've invested $5,000, maybe $10,000 in upgrades. Then the worst happens. Your car is totaled in an accident or stolen and never recovered. Your comprehensive or collision coverage kicks in, and the adjuster calculates the actual cash value of your vehicle. But here's the brutal truth. They are valuing a stock 2022 Honda Civic, not your 2022 Honda Civic with all its incredible upgrades. All that money you poured into it? Gone. Vanished. Unless you have custom parts and equipment coverage or CPE. This specific endorsement increases the coverage for your aftermarket parts. You document your upgrades, you pay a small premium, and if your car is totaled, you get paid for the value of your car plus the value of your custom equipment. If you've personalized your ride in any significant way, CPE isn't a luxury. It's an absolute necessity to protect your investment. Now for the big one, the single most financially devastating gap for anyone with a car loan or a lease. And in California, with our high car prices, this is critical. It's called gap insurance. And the gap it covers is the one between what you owe on your car and what your insurance company says it's worth. Let me paint a picture for you. You just bought a brand new SUV. You were so excited. You drove it off the lot and it cost you $45,000. A year later, you get into a major accident, and the car is declared a total loss. In that year, you've paid down your loan and you now owe $40,000. You file your claim, and the insurance adjuster comes back with the actual cash value of your car. Because of depreciation, that immediate drop in value the second you drive a new car off the lot, they determine your car is now only worth $34,000. Your insurance company writes you a check for $34,000, but you still owe the bank $40,000. That check goes straight to the bank, and you are left with a $6,000 bill. Let me repeat that. You have no car, and you have a $6,000 loan for a vehicle that no longer exists. It's a financial nightmare. Gap insurance is designed specifically to prevent this. It pays off that $6,000 difference, that gap, between the car's value and your loan balance. If you are leasing a car, it's almost always required. If you're financing a new car, especially with a small down payment, you are taking a massive financial risk without it. Let's circle back to the question I asked before. What about the stuff inside your car? Your car gets broken into. They smash the window. Okay, your comprehensive coverage will handle that minus your deductible. But they also stole your new laptop, your expensive sunglasses, and your golf clubs from the trunk. That's $4,000 worth of personal belongings. Is that covered by your auto policy? The answer is almost always a hard no. Auto insurance covers the car itself, not the loose personal property you keep inside it. That's what your homeowner's or renter's insurance policy is for. Your renter's policy, which you can get for as little as $15 or $20 a month, would cover that stolen laptop anywhere in the world, whether it's stolen from your apartment or your car. However, some insurance companies are starting to offer small, limited endorsements for personal effects coverage. It might only be for a few $100s, but it's worth asking about. The key takeaway here is to never assume your auto policy covers your belongings. You need to have a separate renter's or homeowner's policy to be truly protected from the rampant smash and grab theft we see in so many California cities. Finally, there's a more subtle but important add-on for people who are particular about their cars, especially newer or high-end models. It's called OEM parts coverage. OEM stands for Original Equipment Manufacturer. These are the parts made by your car's company. A genuine Toyota part for your Toyota, a genuine BMW part for your BMW. When you have a standard policy, if you need a new fender or bumper, your insurance company has the right to pay for an aftermarket part. These parts are made by third-party companies. They're designed to fit and function similarly, and they're cheaper. For an older car, this is usually fine. But for a newer car, especially a luxury or performance vehicle, using aftermarket parts can potentially decrease the resale value, affect the fit and finish, and in some cases, even impact the performance of advanced safety sensors that are built into bumpers and side panels. OEM parts coverage is an endorsement that guarantees your insurance will pay for the original, factory-spec parts during repairs. It costs a little more, but it provides peace of mind that your car is being restored to its exact pre-accident condition, using the parts the manufacturer intended. So there you have it. Rental reimbursement, roadside assistance, custom parts coverage, gap insurance, and OEM parts. These aren't just upsells. They are strategic tools. They are the specific patches you use to seal the holes in your financial armor, turning a standard one-size-fits-all policy into a custom-tailored suit of protection that fits your exact life and your specific vehicle. You now understand the full menu of options, from the basic requirements to the expert-level add-ons. You've essentially built the perfect, bulletproof insurance policy on paper. You know exactly what you need. But there's one final crucial step. How do you actually get this policy without paying a fortune? How do you find the hidden discounts that companies don't always advertise? How do you navigate the treacherous waters of insurance quotes to make sure you're getting the best possible price for this ideal coverage? That is the final piece of the puzzle, and it's where we're going next. First, understand that finding the best price isn't about finding a single magic company. The company that's cheapest for your neighbor might be the most expensive for you. It all comes down to their specific risk calculations. Your mission is to find the company whose algorithm loves you the most. To do that, you have to cast a wide net and fight on three distinct fronts. The first front is going direct. This is you, on your computer, going straight to the websites of companies like Geico, Progressive, or Esurance. The pros? It's fast, you can do it at 2 in the morning, and you're in complete control. The con? It's incredibly time-consuming to do this for 10 different companies. You're the one doing all the work, inputting your information over and over again. And crucially, there's no expert in your corner to offer advice or point out a coverage gap you might have missed. The second front is the captive agent. Think of your local State Farm, Allstate, or Farmers agent. They are captive because they only sell products for that one company. The huge advantage here is that you have a personal relationship. You have a name and a face, a professional who can advise you, answer your questions, and help you through the claims process. They know their company's products inside and out. The downside, of course, is that they can only offer you one price from one company. If that company's rates aren't competitive for you, they can't just pivot and show you a better option from a rival. The third front, and one many people overlook, is the independent agent or broker. These agents are mercenaries for the consumer. They aren't loyal to any single insurance company. Instead, they have contracts with dozens of them. You give them your information once, and they go out and shop the market for you, bringing back multiple quotes from different carriers. They can offer impartial advice on which company offers the best blend of price and service. This is arguably the most efficient way to get a broad view of the market. The potential downside? Not all brokers work with all companies. So, the biggest direct-to-consumer players might not be in their portfolio. So what's the ultimate strategy? You attack on all fronts. Get at least 2 quotes directly from major online insurers. Speak to one captive agent to see what their best offer is, and consult with one independent broker to see what they can find. This 3-pronged approach ensures you see the widest possible range of options and don't leave any money on the table. But getting the quotes is only half the battle. The other half is making sure every single discount you're entitled to is applied. This is where you can save hundreds, even thousands of dollars. Insurers won't always volunteer this information. You have to be your own advocate. You have to ask. So let's arm you with the ultimate discount checklist. We'll start with the obvious ones. The multi-policy discount or bundling. If you have homeowners or renters insurance, get a quote from that same company for your auto. This is almost always one of the biggest discounts you can get. Next is the multi-car discount. Insuring more than one vehicle with the same company will always save you money. The good student discount is another classic. If you have a young driver on your policy who maintains a B average or better, make sure the company knows. And of course, the safe driver discount. Going years without an accident or a ticket is a huge deal. Now let's dig into the discounts people constantly miss. Let's talk about your vehicle itself. Do you have anti-lock brakes? That's a discount. Do you have an anti-theft system like a car alarm or a low jack? That's a discount. Passive restraints like automatic seatbelts or airbags? Discount. Daytime running lights? Believe it or not, that can be a discount. Next, let's talk about you, the driver. Did you recently take a defensive driving course? In California, completing a mature driver improvement course if you're over 55 can provide a mandatory discount for 3 years. Ask about it. What about your mileage? If you have a short commute or work from home, you should be getting a low mileage discount. This is a massive factor in California. Some companies now offer telematics programs where you use a plug-in device or a smartphone app to track your driving habits. If you're a genuinely safe driver, you don't brake hard, accelerate aggressively, or drive late at night. This can lead to substantial savings. Then there's a whole category of discounts based on your affiliations and profession. Are you a member of an alumni association, a fraternity or sorority, or a professional organization like the American Medical Association or the Bar Association? Many of these groups have negotiated special rates for their members. Your job title itself can be a golden ticket. In California, your occupation is a permitted rating factor. Certain professions statistically have fewer claims. Engineers, scientists, teachers, firefighters, police officers, and medical professionals often qualify for preferred rates. Always ask if your profession gets you a discount. Same goes for military service. If you're an active duty service member or a veteran, there are often specific discounts available to you. Finally, there are the simple administrative discounts. Agreeing to receive your documents electronically via paperless billing can knock a few bucks off. Setting up automatic payments from your checking account, known as EFT, often comes with a small discount. And the big one, paying your premium in full for the 6-month or 1-year term. If you can afford to do it, paying upfront can save you a significant amount compared to making monthly installment payments, which often come with service fees. Now, a critical note for California drivers. You might hear people in other states talk about their credit score affecting their insurance. In California, thanks to Proposition 103, that's illegal. Insurers are not allowed to use your credit score to set your rate. The 3 primary factors by law are your driving safety record, the number of miles you drive annually, and your years of driving experience. This is great news for consumers, as it puts the focus squarely on how you drive, not your financial history. It also makes providing accurate mileage estimates and keeping a clean record more important than ever. So here is your step-by-step game plan to win the insurance game. Step 1: Preparation. Gather your intel. You'll need the driver's license numbers for all drivers in your household, the vehicle identification number, or VIN, for each car, and a copy of your current insurance policy's declarations page. This page is your cheat sheet. It shows exactly what coverages and limits you have right now, making it easy to compare apples to apples. Step 2: The attack. Execute the 3-pronged approach we discussed. Go online and get quotes from 2 direct insurers. Call a captive agent, and contact an independent broker. When you're on the phone or filling out the forms, have your discount checklist in front of you. Don't just tick the boxes they show you. Actively ask the agent, do you offer a discount for my profession? For my car's anti-theft system? For my alumni association? Be proactive. Step 3: Analysis. You'll now have a pile of quotes. The first thing you do is make sure they are for the exact same coverage. One quote might look cheaper, but it could be because they quoted you state minimum liability while another quoted you the 100/300/100 we recommended. Create a simple spreadsheet. For each quote, list the company, the total premium, and then a column for each coverage type. bodily injury, property damage, uninsured motorist, collision deductible, and comprehensive deductible. Lay it all out so you can see a true side-by-side comparison. Step 4. The final decision. The lowest price is not always the best choice. A rock-bottom price from a company with a terrible reputation for customer service can turn into a nightmare when you actually need to file a claim. Before you buy, do a quick search for insurance company name claims satisfaction reviews. See what real customers are saying. Organizations like J.D. Power also release annual rankings on insurance company satisfaction. A company that costs you an extra $10 a month, but has a stellar reputation for paying claims quickly and fairly is worth its weight in gold. And there you have it, the complete blueprint. From understanding the fundamental purpose of liability insurance to building a policy that protects your unique financial world, and now to a strategic plan for finding the best possible price for that protection. You are no longer just a consumer. You are an informed, empowered buyer. You have the knowledge to cut through the jargon, to ask the right questions, and to build a policy that lets you get behind the wheel every single day with true peace of mind. Insurance is not just a legal requirement. It's the financial firewall that protects everything you've worked for. And now you know exactly how to build it right. Drive safe.